This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be sharing with you a stock that I recently bought on the ASX. In my previous portfolio update, I did mention that I'll give you guys updates if I did buy any stocks on the ASX. So I finally did buy a stock on the ASX after researching 4 stocks on the ASX for quite some time. Unfortunately, the market is very overvalued at the moment, so it's quite hard to find any stocks that I would consider buying, although I did start to build a very small position in this particular stock. So without wasting too much time, let's get right into the video. So the stock that I recently bought was Kogan.com Limited, stock ticker KGN ASX. The stock currently trades at $10.15 Aussie dollars, and the company has a market cap of $1.08 billion, which makes this stock somewhere between of a small to mid-cap stock. Now, in terms of the business, Kogan.com Limited operates a portfolio of retail and services business. So most commonly known business of Kogan Limited is the Kogan retail website, but they also operate in a few other verticals such as Kogan Mobile, insurance, health, marketplace, energy, credit card, so on and so forth. They also own the Dick Smith brand, so that is Dick Smith Australia as well as Dick Smith in New Zealand. And most recently in December last year, Kogan.com actually did acquire the Mighty Ape brand. So Mighty Ape is a New Zealand based online retailer, which I actually do use quite often. So I'll talk more about Mighty Ape a little bit later. But in terms of the Kogan retail business, Kogan.com Limited sells a wide variety of different types of electronics, toys and games, fashion, as well as groceries. So you can see the whole product line over here. They do sell a lot of cheap and affordable products, and they also sell their own exclusive brands. So they do own brands under the Kogan brand, Komodo, Ovila, so on and so forth. So these exclusive brand products actually do contribute to a relatively large percentage of the total revenue for the group. Now, in terms of their exclusive brand strategy as well, they've seen tremendous growth over the past year. So compared to the first half of FY20, there has been a 114.9% growth in revenue in the first half of FY21. And Kogan also sells other third-party brands such as Samsung, Apple, and so on and so forth. But Kogan doesn't actually make as much of a margin on these products compared to their exclusive brands product. Kogan also runs a marketplace where other retailers and distributors can list their product and sell on their platform, and Kogan will in turn get a small commission on each sale made on their platform. And this is a growing part of the business. This is actually a business that has done tremendously well over the past year as more retailers and distributors sell their product on Kogan's marketplace platform. And as I mentioned earlier, on the 3rd of December, Kogan also acquired Mighty Ape, which is an online retailer based in New Zealand. And we can also see that this platform is very sticky. As you can see over here, there is a huge number of orders made by customers who have ordered more than 10 times using the platform. So this platform has a really high level of customer satisfaction, meaning more customers come back and purchase from their store. So this is an acquisition made in December 2020, and Kogan had a purchase price for Mighty Ape of roughly 122 million Aussie dollars. Now, if we take a look at the business model of Kogan, it is actually not that complicated. So Kogan is aiming to increase their product selection or their services selection, and what this does is that it improves the customer offering, and what that does is that it attracts more customers to come onto the platform and purchase their products, which in turn creates scales of efficiencies as well as increasing customer acquisition and retention. And what this does is that with more customers come more partners and products as more suppliers want to make more money selling on the Kogan.com platform. What that does is that it improves the consumer offering, and that just keeps going round and round, and that is the Kogan.com virtuous cycle. So that is basically what the business does in a nutshell. So now let's take a look at some of the financial metrics of the business. Now, if we look at the total revenues of Kogan has been growing actually quite steadily over the past few years or so, starting from around around $173 million of revenue in 2013 to currently around $500 million in the last financial year. So this company has been growing very steadily, and we can see in the most recent half-year results, their revenue is $414 million. So that is almost as much as what they've done in the full year last year, right? So that represents an 88.6% growth in revenue in the first half year of FY21 compared to the first half year of FY20, and all the other metrics over here is a very big positive green number, right? Revenue up 88.6%, gross profit up 126%, gross margin up 19.9%, EBITDA up 132%, so on and so forth. And as you can see, while revenue has only gone up by 88.6%, EBITDA has gone up by 132.4%. So that signifies operating leverage. So Kogan is enjoying economies of scale, meaning that the more that they sell, the more profit that they make as a percentage of revenue. All right, so that is very important, and that is a very good sign to see the margins expand. And this translated to an EPS growth of around 135%. Now, Mighty Ape was also a very good acquisition in my opinion. The company is forecasted to make $137.7 million in revenue for FY21, and they did acquire this company for $122 million, if I remember correctly. So that is less than one-time sale. And this company is still growing quite significantly, even though it's been around in New Zealand for quite some time now. Revenue is up 43%, gross profit up 58%, and EBITDA margin also up 6.2 percentage points. Now, in terms of the business over the past few years, we can see this trend very clearly. Gross margin increasing from 19.4% to 27.3% over the past 3 years. And we also see the contribution margin increasing from 11.6% to 15.5%. So this shows a margin expansion over the past 3 years, which signifies improving operating leverage. Now, in terms of the group's gross profit, product, and business mix, more than half of the gross profit is contributed by exclusive brands, sitting at 55.9%. Secondly, third-party brands make up 16.2%, and Kogan Marketplace makes up 11.7%. So this marketplace revenue is actually growing quite quickly and is making up a larger percentage of the gross profit contribution. And the remaining segments over here are the verticals that they have been expanding into. And this small slice over here is the Mighty Ape gross profit, which is currently sitting at 4.8%. However, this only includes 1 month of trading. So that is December 2020 gross profit. So in the next half year and the next financial year, we should see this slice expanding very quickly. Now, in terms of Kogan's moat, I think the moat really lies in the membership offerings that they currently have. So for Kogan, this is under Kogan First, and for Mighty Ape, this is under the Primate subscription. So this subscription or this membership allows you to have free delivery on thousands of eligible products, upgrades to express shipping at no extra cost, priority customer service, and enjoy access to exclusive member-only deals and discount. And that is quite similar to what Mighty Ape also has. So basically how this works is that you pay a one-off annual fee. So for example, on Mighty Ape, I paid $48 and I get unlimited shipping for the whole year. And I want to bring you guys back to this slide over here for Mighty Ape repeat orders. And as you can see over here, there are a ton of orders made by customers who have made more than 10 orders in total, all right? So that's a highly engaged customer base with over 70% of New Zealand customers being repeat customers. So in my opinion, this is a relatively small moat because, you know, it's not everything. Customers will go to the cheapest provider, but if they have free shipping and your prices are slightly higher, they'll still go with you because they have free shipping. All you need is a little bit of an advantage over your customers to get them coming back to your platform, and that even means an advantage that they get if they pay you, right? So that is the Primate and the Kogan First subscription. And as I mentioned before, I am a user of Primate. I have activated my 12-month subscription actually just last month to buy some Pokemon cards as well. So now let's talk briefly about some of the risks involved with this stock. As you know, this is a high growth stock, and over the past half year or so, the stock has been down 59.8%. Now this drop was somewhat caused by the third quarter trading update provided by Kogan. Basically what the company said was that during the period the company landed inventory ordered in response to the high levels of demand seen throughout the first half of 21. This led to the company achieving very strong inventory levels and rolling out some very exciting new product launches. In the 3 months to March 2021, customer demand fluctuated below the levels seen in the prior 9 months to December 2020. As a result, the company was required to store larger than expected levels of inventory, incurring high storage expenses and demurrage fees, which are expected to be finally resolved from May 2021. The company has been progressively working towards optimizing the inventory position to reflect current market conditions by increasing its promotional activity. So, two things that stick out over here. One is that they will need to spend more on marketing to sell their excess stock. And secondly, they have incurred more storage expenses and demurrage fees, which basically are fees involved when you don't take out the stock out of the ship. So the ship stays on the dock and they charge you a penalty because, the ship isn't able to go off and do more business. So that is the demurrage fee. And this has a drag on the EBITDA margin. As we can see, adjusted EBITDA now down more than 24% in the prior year. All right, so that is a huge concern to the market, causing the sell-off in the stock. Now, in terms of the inventory levels, this is by far my biggest concern about this stock, all right? As you can see, over the past 7 years, the stock levels have been growing quite consistently. And the last financial year, it was $112 million. And in the most recent half year, it was closer to $220 million of inventory. And with this third quarter update, we can expect to see that level of inventory potentially going up if they aren't able to offload some of their inventory. And we can also see the inventory turnover levels dropping over the past few years as well. So it was 12.4%, and every year that inventory turnover has been decreasing over time, and currently is sitting at around 4 times. So the company isn't selling stock or inventory as fast as they used to, and this means more cash tied up in their working capital. And it could also potentially mean expenses are tied up in inventory and not released into the P&L because, for example, you can have some of the transport costs involved recorded as an asset in the balance sheet, and this doesn't get reflected in your P&L, your expenses, because it's all in your balance sheet. So this is a little bit of a red flag for me, and actually is one of my biggest concern for the business. Now, in terms of the valuation, however, I think this is fully priced in. So before the whole fiasco happened, the stock was trading at roughly 30 times EV to EBITDA. Currently, the stock is trading at closer to 13 times EV to EBITDA. All right, so as you can see, over the long term, this is roughly near its lows of roughly 10 times EV to EBITDA, and down quite significantly from its previous highs. In terms of its competitors, however, JB Hi-Fi, a electronics retailer in Australia, is trading cheaper than Kogan, but is a slower growing business, of course. And we also have Redbubble, which Frank has covered on this channel as well. Redbubble is currently trading at 15.35 times. So Kogan is somewhere in the middle at 13 times. And if we look at the average EV to EBITDA multiples in the retail and trade sector worldwide, Kogan is trading well below the averages of between 20 and 30 times over the past 2 years. On that basis, Kogan does look like a relatively good deal, but this is all relative at the moment. The whole market could crash, as we've seen in the past few months with retail stocks, especially retail investor stocks, I should say, not retail stocks. That has caused a huge sell down in growth stocks, growth names, including Kogan. So there's always more room to fall for a stock like this, but I think this is an attractive price point for me to start a very small position. Now, this stock also pays a nice dividend. So dividend has been growing over the past 4 years or so. Last year, they paid 21 cents in dividends. The first half of FY21, they did pay out 16 cents. So that equates to roughly 3% dividend yield, which should help me lower my cost basis over time. Now, I've started a very small position in my Sharesies public account. I've bought 100 shares in Kogan at an average price of $10.12 per share. So that is $1,000 I have invested roughly in the Sharesies public account, but I haven't started a position yet in my private account. I'll be doing more research on this stock as time goes on so that, if I can increase my conviction levels, then I will increase my position in the stock. And also, because there is that issue with the inventory position, I think we'll get a good update in the fourth quarter, and based on what I'll see coming, I will either add or reduce my position in Kogan. So I'm really excited about this company, and I think this company has a huge runway for growth over the long term as more people shift to online retail, and this company benefits from that industry tailwind. But in the short term, there are concerns around inventory, which is why I've only initiated a very small position in my public portfolio. So let me know what you think about Kogan.com Limited in the comment section down below. If you enjoyed today's video, be sure to hit like and subscribe. And until next time, guys, take care.